When should you do put spreads and when should you do call spreads? Do you know how to differentiate those? Do you know when one is better than the other? This is what we're going to be figuring out in today's video. So let's get into it. Welcome back everyone to another video. As I said before, we're going to be looking into put and call spreads. If you don't know, spreads are one of the income products that we have here in Bitopics. I showed you in other videos how profitable they can be, both on a passive income, long-term, long expiration option strategy, but also for the weekend strategy. We're going to start to do the weekend strategy with more frequency here on this channel. So if that's something that interests you, and again, if you didn't see the last video where we made 4% in a single day, check it out right here on the top right corner. That's a very good video that explains you the weekend strategy. But beyond that, when should you choose a call spread between a put spread? Well, they're both spreads, but they want something different. The outcome is different for a call and a put spread. So how can you differentiate that? Well, let's go to Bitopics here and take a look. Now, what you're looking at is the income products tab here on Bitopics. You simply go to bitopics.io and you click right here and go to income products. This is what you're looking at. We're looking at the same thing right now. Here it works by expiration. So you can see this row that you have right here, they all expire at the same date, which is April 12th. And on the bottom, we have June 28th. And even below that, we have 27th of September. So these are the strikes of the available strategies. Of course, they come and go depending on how far away from the price they are. So according to liquidity, they're going to come and go. But again, you can be checking these daily, that they change, they update very, very fast. So how do you differentiate a put from a call spread? Well, short answer, very, very simple. Here we label those as green and red. So if you see a red here, it means that it is a put spread. You want it to go down. And if it is green, it is a call spread. You want the underlying asset to go up. So other than to just check for APR here, for ROIs here, we're not going to be analyzing those today, but let's just analyze on what does it mean? What are you looking at in the charts itself? So let's start actually with this 2% here, the 65,000 strike, because that's a good one for us to understand and to start looking into it. So all of these for the 12th are call spreads, which kind of makes me think that the market itself is all bullish because there isn't a single put spread here. So the demand itself for put spreads is very low, it seems. So this is good for us which hold Bitcoin, which is my case and I believe is also your case. So let's draw a P&L here of this strategy straight on TradingView so you can see the price itself and what does it mean for you. So currently the price is at 71,843 for Bitcoin. This is the price of Bitcoin right now. So what we have to look again is the 65,000 on expiration April 12th. So let me draw that here real quick and we can come back to this later. You can see we have two rectangles, a green and a red. This means profit and loss. And these rectangles start at today's candle. So right now, the current candle, and they end on expiration. So what you see in the size itself is the amount of time that you have left. So everything that you see between these two vertical lines is the time that you have left for this operation, for this trade. And this line right here where all of these meet is the 65,000, is the strike itself. So what are we looking at? It means that if by the end of this vertical, the second vertical line right here, if Bitcoin stays in the green area, you're profitable. You made that 2%. If Bitcoin stays in the red area, you lost. You lost 100% of the amount of money you deposited. So in our case, let's say you put $100. If it stays in the green, you made $2. If it stays in the red, you lost $100. So this is the P&L for these strategies. And of course, it works the same way for a put, just reversed. So the green area is going to be at the bottom and the red area is going to be at the top because a put spread is bearish. So you want the underlying asset to go down to stay below a certain price. And as I said, we're not analyzing yield. We're not analyzing return of this strategy because again, 2% could be very low of a number. So we're not discussing the numbers itself, the ROI for these options, because of course you see there are 23%, 500%, 5,000%. So you can see how volatile these numbers can be. And this is not the purpose of the video, is to show you and visually understand when should you go for a call spread, for a put spread. For a put spread, on the other hand, let's take a look at this expiration here, the 28th of June. Let's go for the $28,000. So this is very, very far away from the current prices. But if you believe Bitcoin is going to correct, this is a great strategy for you. So let's analyze this here in the charts. What you're seeing is the red now is above and the green is below, the opposite of what we just saw in the last one, because this is a put spread. The put spread is bearish, so we want the underlying asset to go down below a certain strike. So the strike here that we chose is $28,000, as we showed before. So this line right here is $28,000, and here is where the 28th of June ends. So this is 28th of June's on expiration date. And here is the current day that we are. So we have 81 days to go, as we can see right here, 81 days to go for this strategy. And what do we want? We want that by June 28th, we want Bitcoin to stay right here. So you can actually draw it out. We want Bitcoin to, it doesn't really matter if it goes up, if it stays up. It only matters that by this day is inside this green line. So when it reaches the date of expiration, it needs to stay inside the green box. This means that we profited. And how much we made? Well, if we go back to the strategy, we made 1,745%. What does it mean? It means that if you put $100 right now and this option actually goes in your favor, you make $1,747 extra dollars. So you add these to the $100 that you deposit, you get that back. But Everton, what if it stays inside the red? Well, you lost that $100. So you can see how it can be very asymmetric if you count how huge returns you can have or how passive it can get to a point that it is not risky for you to be doing these over and over again, as we saw in previous videos. So what I'm trying to say here is not that this a put is better to make money and a call is better to make passive income. No, this is not what I'm saying. The numbers that I chose, the put that I chose had different expiration dates than the call that I chose. So it's not fair to compare those, the ROI between those two. But now you at least understand, you have a visual representation on what to expect from both sides of a put and a call spread. Well, if you understood and this was clear to you, please comment down below what else you want us to explain, what else you want us to simplify, because this is the goal of Bitopics. We want to simplify options, make sure everyone can access the powerhouse that options are for your portfolio, not only for speculating, but also for hedging, for passive income, for a lot of different things that you can do with this amazing derivative. So if you think someone could enjoy this content, just click the share button and send it to them. And as always, we appreciate every one of you that does so. So if you did all of this already, don't forget to like, subscribe, and turn on notifications so you don't miss these next videos that we post. And before we go, I wanted to say thank you for the huge amount of love that we're seeing in these videos. So thank you very much from the bottom of my heart. I'll catch you guys in the next video. Peace out.